Well, hello there. How are you doing? My name is John Sluice with Entrust CPA. Thank you for joining us. Today we're going to talk about the Tax Cuts and Jobs Act, commonly said TCJA, or more specifically, the 2018 tax law change. It's the one that really decreased taxes in 2018. Many of us now have been operating under this for a while and have forgotten that it's a relatively new thing. It was revolutionary in what it did. It has lowered tax brackets and tax rates for many, almost all, for these last several years. What I'm here today to talk to you about is if you have not considered or thought about or planned for the fact that many of these tax provisions or these tax changes sunset or go away at the end of 25. And so if you have not done tax planning related to this, you need to be. Even if it's just some passive planning and just knowing and feeling comfortable with where you are, that's okay too. But most of you listening to this should be consciously thinking about what it is you are doing or are not doing in your tax planning. Now, if you've done planning with us, we have already incorporated it, whether we've mentioned it to you or not. We're having discussions on this. We're talking to you about these. We're building them into our plans. But we need to be thinking about it consciously of what's happening here. So in today's video, I'm going to spend some time kind of going through what it is and what you have to be aware of, mainly enough to know to ask the questions. We're not going to be doing individual planning. We're not going to be doing some of the strategies around it. I might summarize them towards the end of the video, but we're going to just introduce to you what you need to be aware of and what is going away. The biggest thing that you need to be aware of related to this is that the default is do nothing by Congress is it goes back to what it was. It reverts back to the way it was. The changes were temporary, otherwise known as they are sunsetting. So if you're listening to media, that's probably the word you're going to hear is sunset, which means in 2018, they made temporary plans because they had to budget for it and they had to be able to account for all of the significant tax savings that were in there and the cost to government. If they made it permanent, it would never have been passed. And so by making them temporary, they were able to pass them. And so if Congress does nothing, it goes back to what it was in 2018. Now, some of the things I believe they're going to try to address, but some of the things I don't think they're going to be able to, and we're going to go through some of those different items. Specifically, Congress has now tried 2 years in a row to put things in place. You might have heard about the recent stalemate that occurred with the individual child tax credit. That's an example where they recognize it's going to revert back to what it was, and they're trying to get them in place to make them permanent, but they have not been able to do that yet. Partly because there's arguing and politics that are happening, what gets included and what does not get included. Again, what I'm going to stress is in order for these not to go back to what it was, Congress will have to act. Now, what's interesting to me is the fact that regardless of what side you fall on, whether it's Democrat or Republican, both have presented that they do not want to increase taxes for anyone making, depending on who you're talking to, $400,000, $425,000, or $450,000 in income. Well, that means that Congress is going to have to do something. Both Republicans and Democrats say they want to keep those incomes not increasing. If the default is going to revert back to what it was, by default, everyone listening to this video is going to have increased taxes coming through. And so if you have less than 400/425/450,000 in income, that could be you. And so I do think there's likely going to be some things that are going to be corrected or fixed. But I do think there's going to be others that are not going to be, especially given the fact that they have tried twice now in the last 2 years and have failed at passing anything. So there will be some things that don't get corrected and adjusted. Now, the next thing I'm going to point out is that this is related to individuals, right? So there were two significant things that went in place: individual tax laws and business tax laws. In 2018, they did both of those. The business ones were permanent. They're not going away. It's the individuals that would sunset. And so that's really what we're going to focus on. Now, there is one little weird one that fits in the middle. It's called QBID. It feels like it's a business item, but it's actually an individual because it's taken at the individual level. Keep that in mind because I'm going to talk about that, and that actually has huge implications if you're a business owner. But I'm going to go back first and talk about some things that are going to change for individuals. The first one is the simplification. That was the main thing and the main purpose of this 2018 tax law change, was it simplified. So for many of you, you remember when you used to have to keep all your receipts, you'd have to keep your charitable donations, your medical, all of those itemized deductions. And how they changed that was they increased that from what was, say, I'm rounding at 12,000 and now it's much higher. Well, that reverts back to what it was before. So we might pull back to the days when you have to keep the shoebox worth of all your receipts. That's going back to that. One interesting thing is the SALT limitation that hit many high earners, that is limited to $10,000, that uncaps as well. So we will see a little bit of a positive impact there if they don't fix that. But that probably is going to have the biggest volume of impact for individuals, right? So that will impact almost every American that's a taxpayer. I do think that they're going to try to address that, just because to go back to the way it was before is going to just cause earth-shattering ramifications and ripple effects. And so I am hoping that they correct that and fix that one. Again, we'll wait to see, and there is nothing that is in concrete yet at this point. So as of right now, unless they change it, it will go back to what it was before. Another one, and this is probably the largest thing you need to hear, is the rates are going to go back to what it was prior to this. So this reduced down the rates. And so this, well, when it goes back, it's going to go back to the higher rate. So they're both condensed. So the bracket, the range of the lower rates is smaller, and the higher tax bracket was 39.6, is now 37. It reverts back to what it was. And so the tax rates are going to go up. A couple other items where you're going to feel the impact is the child tax credit. So that was increased. That's actually what they tried to pass through here. I mentioned that last year. It got stalemated, so that goes back because right now it's at $2,000. It reverts to back what it was before at $1,000. And then the personal exemptions. If you remember, you had to have those as well. Again, that was part of that simplification. That goes back. So there's a lot of things here that we've now gotten used to that feel like they're just ingrained. It's going to go back to the old ways. Between you and I hope they fix most of those items, and I am imagining they're going to fix several of those, but we don't know, and so you should plan accordingly. And so if you haven't considered this, we should be talking about it as part of your 2024 tax planning. Now, I say this because this happens, it sunsets at the end of 2025, which means we have all of 24 to plan for, and we have all of 25 to do things. So I don't need you to go out tomorrow and start doing things, but I need you to be thinking about this. And we need to be talking, what are you going to do this year, right now? What are you going to do in 25? So that way, come 26, when the new law goes back into place, we've at least considered it. Now, I'm going to move on to individuals. And again, I put in quotes because the biggest impact that I feel that's out there is for small business owners is QBID. That's qualified business income deduction. Now, I started the video out saying this is for individuals only and it's not business. So many people assumed that this business deduction was going to be permanent, but it's not technically a business deduction. It's an individual deduction. It's taken at the individual level, not at the business level. It is a result of business income, but taken at the individual level, which is why it's part of this sunsetting. What you as a business owner need to hear is that QBID is a free 20% deduction on your profit on wages in the United States. So for many of you listening to this, if your income is entirely generated in the United States and if you're profitable, you got a free 20% deduction. So if you made $100,000 in business income, you got a free 20% deduction. That's big for many of you, right? That's going to, on that example there, you're going to have another $20,000 of income that you're going to feel that you've gotten used to not having that as a deduction. So you should be budgeting for the fact that come 26, if this doesn't get adjusted or extended, your taxes are going to go up by potentially 20%. That's not small, and we need to be thinking from a cash flow point of view what that has in place. Now again, I'm going to kind of summarize at this point and stop here and say Congress has said, both Democrats and Republicans, that they don't want to increase taxes for anyone that's making less than $400,000 or $450,000. Many of these things I just mentioned are going to result in an increase to people making that less than that 400 and 450,000. So I have to imagine they're going to do things. We don't know for sure, but we're going to plan accordingly, and we're going to want to strategize and think through. I do think, I've mentioned this a couple times in this video, but I do think that they're going to really try to address this to some extent. Now, if you're a small business owner and you're making $700,000, I have a feeling they're going to phase that in or phase that out already. So they're going to probably do some phasing of nature, but I do think they're going to address these. But you should be considering it. And stay tuned to the end of this video where I'm going to give you some high-level strategies. But before I go to that, I'm going to hit now the next bigger item. And this is one that I think you need to hear if it applies to you. Because unlike the individual in the QBID, which I have a hope that they're going to try to address, I would surmise that they're not going to try to change this next one, which is the estate and gift tax change. Okay, so part of the TCJA, the 2018 tax law back in 2018, was they increased or they doubled the estate tax limitation or phased or standard deduction. So if your estate back in 2018 had less than $5,490,000, you don't pay estate tax. Okay, so that was many individuals that were out there that said, okay, my estate is less than that, I don't have to worry about estate tax. They doubled that. And so now, at the time in 2018, it was $11,180,000. So they just doubled it. That's an important thing to hear, right? So what they didn't increase it from the, I'm going to round 5.5 million to the 11 million, or they didn't increase it. They just doubled what was there. So when they sunset this, they just eliminate the doubling. That's a little bit of political speak there. Again, they didn't change the number, they just doubled what was there. In 2025, that doubling goes away. Now that also has increased every year, right? That gets adjusted for inflation. So you're going to hear different numbers here, which can lead to some confusion. But in 23, for example, it was 6,460,000, doubled to 12,920,000, right? So what you need to hear, I'm going to round 6.5 million, doubled to 13 million. It's not the exact number, but you get the gist, right? What's going to happen there is if you have 6.5 million, currently if you have 13 million, if you pass away and you have $13 million in your estate, you're subject to estate tax. And that's if you pass away in 24 or 25. If you pass away in 26, it reverts back to that $6.5 million threshold. Now here's why I don't see them doing too much to this. Because most individuals, in my opinion, are going to say, well, you know what? If you have an estate of 6.5 or an estate of 13, you're still more than the average. Therefore, you need to be thinking about it. So that's where I don't see the politicians, falling on a sword to change that one. I do see them doing the individual ones, but this estate one, they don't. I don't see it. So if you have an estate, you need to be thinking about this. And when I say you have an estate, every single person has an estate, right? You need to be thinking about it. Now, it's still not going to apply for many of you, right? If you're listening to this in your estate, what is the value of what it will be when you pass away? Not today's dollar, what it will be when you pass away. If it's less than 6.5 and you know it's not going to be less, or you know it's going to be less than 6.5, then we don't have to worry about it. But that number now, when you include your house and you include life insurance proceeds and you include 401k, it's starting to approach that number that more and more people are going to have to think about it. Again, it's not a foregone conclusion, but if you're bridging that or getting close to it, we should be doing things now to plan for the 2026 because we have a year 2024 and year 2025 to do things. And I will tell you that nothing in the estate world goes quickly. It's designed that way on purpose. And so if we're going to put things in place beforehand, we should be doing it now versus then. So if you have an estate and you kind of calculate out what you think it will be, and if you think it's going to be closer to the 6.5, I'd even dare say if it's going to be around 5 million, you should be thinking about what we should be doing from an estate planning. If nothing from this video here, you should ask the question with us, hey, should we be talking about this? And we can make an easy conclusion pretty straightforward and pretty quickly. No, you don't need to worry about it. Or, yeah, we should need to worry about it. Because if you ask me, the estate tax, I often kind of call it a lazy person's tax, right? Because it's a tax that we entirely can avoid if we do things ahead and do them properly. For most people, like if you're a multi-billionaire, maybe not, but for most people, there are strategies that are out there that we can do to avoid this. And so if you don't do this and you actually end up paying the estate tax these days, it's because you didn't do the planning. So do the planning that comes with it. And just to kind of give you a number, the estate tax, the federal estate tax is currently 40%, not to mention the state of Michigan one, so, or this, whatever state you're in, they can go up all the way to 20%. So you're looking at somewhere between 45 to 60% tax on your estate. So give you a rough number, if your estate is worth $10 million and you didn't do tax planning on the estate tax, your estate tax will be somewhere between $4.5 million and $6 million. That's when you hear, if you've ever watched the movies and they say that, you know, the estate tax is going to hit the multi-generations, that's what they're talking about. The estate tax is easily avoidable. And so if you are broaching onto this number, the lower number, we should be doing the planning and take the time to do that now. So I've talked about individuals. I've talked about the business/individual, which is QBID. I talked about the estate and gift. There are others. Again, the takeaway from this is you should be talking to your tax preparer about what you need to be doing today for the sunset in 2025. Some of the things that we're going to be talking to you and giving you suggestions back would be thinking about the estate tax. That was the one I just hit on pretty hard. We're going to be doing timing of income and deductions, and it's going to sound funny, but it's reverse of what most accountants typically say, right? Generally, we're trying to push off income and we're trying to accelerate deductions. Well, if we're in today's tax bracket and we're in a lower bracket than what we think it's going to be in 2 years, we might want to take more income this year and save the deductions for the future. So it's kind of reverse from the normals. We need to be thinking about that. I'm not saying going to do it, but I'm saying that we should be thinking about it, okay? One example would be Roth conversions. Maybe we want to take the income today to save it in the future, more so in pushing it into it. That QBID, right? So that business deduction, you'd be better off having more income this year and 2025 as well to have that QBID and save the deduction for the future year if we don't think QBID is going to get extended. Another one, we're seeing increased capital gain transactions. So individuals are selling businesses or you're selling stocks because the capital gains rates are at lower rates right now. And so more and more people are taking advantage of that before the unknown of what's going to happen after this point. So you might be thinking about, okay, this major life event might be triggered sooner than maybe you might want. So there are items like that. So we're talking about accelerating income and pushing off deductions. There are other strategies that I would suggest, but are case-by-case specific. So again, what you need to hear from this whole video is the TCJA, so the 2018 tax law is sunsetting at the end of 2025. If you're not considering it and thinking about it, you should be. Don't go in and make immediate things. This is a longer range planning. It's why we're talking about it today versus later, but we should be talking about it and making a plan. Thank you for listening. Give us a call. We're going to put it on our schedule to meet with you to talk through and make a conscious and realistic plan of what we're going to do for your specific case. Look forward to talking to you then. Thanks.